let's find out what 2026 is going to have in store for us. We've got Vikas Khemani joining in to talk about exactly that. Vikas, hi. Great to have you on the show. Vikas, you've always believed that India's alpha lies outside the benchmark indexes. But unfortunately, pretty much throughout the year, the benchmark indexes have done nothing and pockets of the broader markets have actually lagged. Do you think that's likely to change in the next year?
I think that always happens every couple of years in the market. It's never it's nothing new. If you go back to your memory in 2022, we had a very much similar kind of situation. 21 was a great year, and 22 index was kind of more or less struggling, and towards the end it picked up. And I think very much similar kind of sentiment was there. And then we had a great 23 and 24. And 25 was a kind of tepid year. There were lots of uncertainty, which got kind of corrected. Uh, Fast forward, I think we are sitting on a year of consolidation, a year of a lot of macro positive developments. If you see in last sort of 12 months or so, we have had a good monetary stimulus coming from RBI in terms of rate cut, liquidity infusion, also credit growth policies, and many more. At the same time, we have had many fiscal stimulus from the government, both in form of income tax rate cut and GST cut. Both are all obviously, macro factor, which tends to impact the growth with a little bit of a lag. And that's what I think 26 is likely to happen. We've already seen a good pickup in the earning growth, which I guess only will get better from here. And you are sitting on a market which has done nothing. Earnings have grown. It's not that they've gone negatively. We're sitting on a market where India had underperformed significantly emerging market this year, while it was outperforming previous years. But this year per se has a significant underperformance. Valuations have come in a reasonably good range. Interest rates are looking down. So I think all positives are sort of factored in. And I do believe that 2026 would be a better year than 2025.
Interesting you say that, Vikas. And, like you rightly mentioned, that there is that valuation comfort and earnings are sure to catch up because of, all the policy and the regulatory changes that we've seen given the government's push. But tell me, so then where do you see the profit pools getting created henceforth as we step into the new year?
That the growth will continue. Definitely, banking and financial services would do well. The whole pack, we've been quite positive and will continue to remain quite positive on that. The monetary policy tend to benefit that. Other one where I think a little bit of benefit happens on the consumer side. So we've been quite positive post 15th August on the consumer discretionary side. And that I think is, likely to do well. And it typically tends to be slightly longer trend. So I think at least 26, 27 could be a year for them. Likewise, I think manufacturing, again, of course, there is a little bit of dampener because of US tariff, and as and when that gets sorted out, you could see some sort of pickup happening there. I do believe that it should sort out soon, and you could see 26 could be a good year for manufacturing oriented play, which probably was not so good in 2025.
Right. Vikas, if I were to just ask you, hi, this is Harsh. If I were to just ask you, zoom out a little bit and ask you how the next year will be in terms of earnings and whether markets will preempt the kind of earnings pickup that you're speaking about, or will the markets wait for the earnings delivery to happen and thereafter see a pickup? I'm trying to understand because you seem to be suggesting that markets to a large extent have bottomed and there's very little scope for downside risk now. And maybe I'm trying to understand where the upsides will come from and when.
I think, if you see a market bottomed out in April, in mid of April, and from there it has recovered, while the earning meaningfully started recovering only in the Q2. So typically always market tends to, predict and act ahead of the curve. And whatever today currently we are seeing is, in some sense, the rally what was we saw from 22,500 Nifty to current levels is also expectation of the earning pickup. And as earning kind of picks up, you will have more and more confidence coming through in the following quarter. So I do believe that this year we could see in and around a range of 14-15% kind of earning growth, and it's a good number for a market like this, and where there are no structural risks around. valuations have come down, interest rates are coming down. So all those things are, auguring, pointing very well in the direction of a good equity market.
But Vikas, for equity watchers, this has been a very unique year. The fact that what's actually done well or equally well has been, what's happening in the metals universe. A multi-asset strategy is what's actually worked in the year gone by. Do you think that is perhaps going to be the dampener for equities going forward? Because, given that retail is always the last to catch in on the ride, it's now that you're seeing the euphoria around both gold and silver.
So yes, of course, last year, a large part of the multi-asset return has come because of gold and silver. Now we all know that gold and silver tend to play in, in sort of in spurts. They have consolidation of few years and then again go up. And we've seen a very large rally. While I'm not a great expert on, gold and silver, but from a looks of it, looks like that large part of it is behind. And probably you might not see similar kind of approach or outcomes in case of multi-asset fund in 26 as you do in 25. 25 of the year was a year of poor equity performance and great stellar, metal performance, and which contributed to the performance of some of these funds. Now, if one is expecting a good equity year and not so great metals year, then you will not see similar kind of approach or similar kind of outcome there. And I'm sure people who manage those assets, the funds will do a great job. But my sense is that probably this year may not be great year for them, but I do believe that equities would be a definitely better year than 25.
Vikas, you've spoken about financials, and you have a decent proportion in your portfolio of both lending as well as non-lending financials. Are you looking at some of the smaller names as opportunities or some of the larger ones? Because there's opportunities in both baskets. I'm trying to understand where you feel the risk reward seems better. They're trading below their 5-year averages, etc. And that's where I'm coming, especially on the lending side.
Always, as far as the lending is concerned, which is a leverage business, we've always chosen to stay in the mainstream large companies because, whether it is NBFC or banks, because the cost of capital, which is the most important aspect in lending business, that tends to be the lowest for larger NBFC, AAA rated NBFCs or larger banks, and hence their ability to make money by taking lesser risk is always better than a smaller player, and that's the reason we have always kind of stayed away from smaller players. Even if ever we have played a smaller player, it has always been a tactical, short-term kind of approach rather than a structural holding. So for us, in leverage player, we'll always kind of stick to, unless we understand the risk reward of a particular name given a special situation. Those are very different things.
Would PSUs at all feature, Vikas?
Beg your pardon?
Would PSUs at all feature?
Oh yeah, I mean we've been kind of holding PSU banks for quite some time.
Right.
We have been positive on PSU banks for the simple reason that all these banks, they are incredible franchises. There have been a lot of transformation happen in these banks on asset quality, on technology front, and on the governance front. Of course, there's a long way to go, and each of them can even be further improved. But it's not the same what it was 10 years ago. And many of these franchisees when we bought were available at 0.5, 0.6 book, and some of them have now come in and around 110 book, but still they are 15, 16, 18% kind of ROEs, making companies and growing reasonably well. So with the post consolidation, I mean, we've been kind of, we hold some of them and we've been kind of bullish on this whole pack.
Because in the year ahead, does one really need to make those market cap based calls? Or would you say just be stock specific, mid, small, large, doesn't matter?
It's been more stock specific. Of course, you need to see when you manage a fund, you need to see composition of small and large cap from a liquidity standpoint of view, not necessarily only from a risk reward standpoint of view, because at times when you run a public market open-ended funds, you need to be aware of the liquidity situation. But our approach has always been bottom up. Can we see a 15 to 20% kind of earning growth over the next 3 to 5 years sustainable, which means can and at a reasonable price? And whenever we see those kind of situations, we don't mind kind of buying and staying put in that. And sometimes market will underperform in short term and outperform in long term. So those kind of short term situations, we are very happy to put up with. Our approach has always been more bottom up stories. Of course, you take macro tailwind calls on the sectors, all those things you are aware about it. So how do you marry both top down and bottom up is important. But if I have to choose between 2022 always will be bottom up, which is giving priority.
Me to IT though, Vikas, because the street is still pretty much divided on the opinion on IT. While it started off being a bottom-up story, but now you've got that rupee tailwind at play. How much more legs or headroom to the rally in IT, and does it look sustainable to begin with?
I do believe that IT has a good long legs to go. There's a lot of narratives happening that, AI will disrupt IT services business. We have had quite a contrary view on that. Of course, each IT company will have to, reorient themselves. But every time there's a technology transition which happens, whether it was Y2K to ERP to digitization to cloud migration, Indian IT services have only grown, right? In terms of the scope and in terms of the addressable market. And I do believe this time it's no different. Think in the context of an enterprise. If they have to implement AI-related technology, they have to hire some IT services company, a data organization, enabling them and using those tools. Selecting those tools is a job of IT company, right? So I do believe that you will see an order book of all these companies. If you see, has been doing very well. The order wins have been very well, doing very well. Does not mean that every IT company will do well, and that happens, right? Every transition, new IT companies come and take the lead and become the future leader. That's the job of stock picking. But writing off IT sector per se, in my opinion, will be folly. We've been positive. We've been holding some of the stocks, and we see this sector as a potential good sector.
Interesting. Vikas, within manufacturing, is there a pocket or space that you like, Indian manufacturing, and within that, is there how best are you playing it?
Manufacturing has a very wide connotations.
That's correct.
Currently, it is very specialty chemicals to auto to textile to defense to everything else, right? And you got to look at specific. So currently, we are a lot more favoring some of the chemicals name where there is specialty chemicals minded, not the commodity chemical. We will favoring some of the auto component space because it also is a derivative of the consumer demand which comes consumer discretionary demand which comes from the automobiles because of the current macro trend. So we've been kind of quite positive on that, and we've been holding a few names which are kind of growing well. And then I think you boil down to the CDMO. We've been very bullish for quite some time, and that is playing out. And we think it has a long legs to it over the next 5-10 years, and we'll continue to hold them. So you kind of specifically find out each of these. These are 3-4 buckets. We've been quite positive. Capital goods, we've been quite optimistic and positive and holding few names. This year, some of them had kind of seen correction, but we think that that will continue to do well. Power ancillaries are again a great play. A global power cycle is in the favor, and a reinvestment cycle is in favor. And I guess many stocks in that will also participate. So some of these baskets are, if you see our portfolio construction is broadly based around some of these 4 or 5 segments.
Vikas, with regard to flows, when do you expect the flows to reverse? You understand the macros better as well. Give us a sense on how you're reading the way in which flows are playing out at this point.
I guess you mean the FI flows, right?
That is correct. FIs, DIs, yeah, both, please.
So I think DI flows have been very robust. We've been
Correct.
seeing a very good SIP flow. So I don't see anything changing that. It can only get better. Regarding FI flows, I think 26 will be a good year for the simple reason. I think, till Fed was raising interest rates, emerging market funds were seeing outflow. And India was also seeing outflow in its own proportion. And India was overweight till 2024. 25, when Chinese market started doing very well, obviously China, which was underweight then, had to get readjusted. And hence, a lot of money went from India because India was overweight to go to China. And that's the only choice a portfolio manager has when he is not receiving any more money in an emerging market as a basket. Now, fast forward, I think interest rates are coming down in US, and that will pave the way for emerging markets to receive flows. And the rebalancing trade of China and India, in my opinion, by and large over. Valuation gap is by and large over. So you will see 26, should be a better year in terms of FI flows. Think about it, Indian market held on very well without FI flows, negative flows, and without any sort of support from that. If that were to turn positive, what impact it could have on the markets? And that upside, in my opinion, markets are right now not at all pricing in. That could potentially lead to re-rating as well.
Right. Okay, understood. Vikas, always great chatting with you. And here's wishing you and your entire team at Carnelian a very happy and prosperous new year from all of us.
Thank you, Aisha, and wish you all a very, very happy, prosperous New Year, great 2026 for all of you and your viewers.